Howdy folks, Dr. Jeff Camarda. I am recording this Thursday, January 28th, before I begin my 8 to 10 new Georgetown Law tax law class this evening, 8 to 10 Thursday nights. Gee whiz, it's going to make a young man out of me, I hope. But I wanted to reach out to you and give you my thoughts as I try to make a weekly habit of doing. And the first, I really want to focus on tax. You know, it's become evident to pretty much everybody. I hate to keep beating this drum, but taxes are almost certainly going up. We've had really unprecedented the volume of requests for help, primarily tax, estate, and income tax help from across the country. And if you haven't seen my most recent class in conjunction with Attorney John Crawford on advanced estate tax control techniques, please go ahead and watch it. Got a lot of great feedback, a lot of great powerful information in there. And you'll be shortly getting a letter. As you know, we've combined TaxMaster and Camarda Wealth, so it really is just, I'll call it Camarda-TaxMaster, but you may think of it as Camarda Tax and Estate. But we're integrating these operations and everything will be done in-house. And you'll be getting a letter if you want us to do your taxes. And I strongly suggest you give us a shot. We are really good, and typically we find all kinds of opportunities to save tax that other tax preparers haven't. But we expect, we're getting busy already, and the tax season really hasn't even hit yet. So we'll be sending letters out to you, so-called reservation letters. Hopefully Joyce and Veronica are the team in charge of this. Hopefully you'll get them soon. But if you'd like to get, we will want to prioritize you guys, our cherished clients, our first priority, and students of the Family Wealth Education Institute are the second priority. But we can only do so much before we reach capacity. So if you'd like us to do this, please get those letters or email back in. Just let us know, and we'll get the letter out to you later that you want us to take care of this, and we promise to put you at the top of the list. There'll be a lot of other things in that letter that you may want to have us tweak. Another thing to point out is, a lot of you, and over the years, we've done estate planning recommendations for you, and folks that were not, in the double-digit millions, I'll say. Often we did not suggest estate tax control because of where the law was. Those folks were comfortably on a path to avoid estate taxation. I don't think that's the case anymore. We're not sure where the law is going to go, but it's likely estate taxes are going up probably this year, is my gut feeling. And I think the level where estate taxes kick in will be much lower than it is now. So if you had an estate plan done by us or by others, and it doesn't include specific estate tax control provisions, and I call these kind of trusts FBOS, for Family Bank Ongoing Trust. I think it's more descriptive. You may have heard them referred to as Spousal Lifetime Access Trust, or SLATs. But if you ain't got one of those, you haven't got the optimal tax control mechanism. So you may want to ask us to review and suggest updates and adjustments to your estate planning if you're concerned, as I am, about estate taxes. The other thing I want to talk about, the market really has gotten kind of frenzied. The stuff with this GameStop now is just crazy. And sooner or later, I think the bubble is going to burst badly. And we've taken countermeasures and developed some investment methodology that we're very happy with, and it's produced results that I'm extremely proud of. And I'm looking forward, regardless of where the markets go, to a very robust 2021 performance-wise. But this is from the Wall Street Journal, and I've been singing the song since last summer, but the headline really says it all. If it looks like a bubble and swims like a bubble, several parallels between the dot-com bubble and today's stock market are strong, and this is just a couple days old. So I'm not going to go through the whole thing, but these are the key points that the journal, the article written by James McIntosh, highlights. First of all, exceptional growth in the price of storage stocks. And anything connected to electric vehicles like Tesla or clean energy has gone ballistic in the past 3 months, regardless of the financial merits or the profitability of the company. Another parallel to NASDAQ. Remember, 2000, the Y2K bubble, The peak, which went straight up, which is kind of similar to what the graph I'm looking at now looks like, but then came crashing down about 80%, and took 16 years to recover. So those of you that are heavily invested in these go-go stocks and think that stocks go up forever and go to the moon, and I know you didn't believe that a couple of years ago, but your perspective may have shifted, please bear this in mind and err on the side of caution. Second point, they compare as a flood of early stage IPOs, tapping into popular themes, initial public offerings, and the cash shells of special purchase applications. We used to call those blind pools. Back when I was a broker, you put the money into a company, you had no idea what it's going to do. And then later on, after they had your money, they went out and bought a company. They call it special purpose acquisition companies. I think the old blind pool was more descriptive. But these have lately been booming, attracting celebrity backers and allowing companies without any revenue, let alone profit, to join the market. And next bullet point, new investors who don't know what they're doing. I hope that doesn't describe you. Don't get me wrong, there are plenty of smart and well-informed small investors, but stocks are again being swung about by the sort of amateur mistakes made by a beginner hoping to win big. And he says that I wrote about recently a story about how to buy a stock purely because its share price is low, which should be all but irrelevant, but which drove performance in the first couple of weeks like to the moon. Just because the stock is cheap doesn't mean it's good. You got a really expensive stock, could be a great buy. So the stock price really is irrelevant, but what he refers to is new investors who don't know what they're doing don't seem to appreciate that. Another point, old economy stocks soaring as they tap into the popular theme. Detroit stalwarts General Motors and Ford have both managed to sprinkle the magic dust of electric motors over themselves this year, even though it's a tiny fraction of their business. Along with South Korea's Hyundai, shares in the three have gained about a third this year, and GM and Ford are among the best performers in the S&P 500, just because of the pixie dust. Early investors who rode the stocks are selling out. Many of those who are early investors in renewable power, electric cars, have cashed in. Some were all their gains over the shift to other cheaper areas offering growth, even as they continue to believe in the underlying theme. And for the final point is the Federal Reserve has the markets back. Treasury yields are super low, and the Fed has promised not to raise rates. That was reaffirmed this past week with a relatively gloomy outlook on the economy that was just released, I think, Wednesday, that justifies higher price for stocks with reliable long-term cash flows. But of course, and so long as rates are low, that does argue for higher stock prices. But of course, investors might be wrong either about future cash flows from these companies, that like Apple, they're just going to keep growing and growing and growing. But a lot of these cash flows are way, way out in the future. And he warns about, the gathering antitrust clouds, which are basically anti-monopolistic regulations to control these huge tech companies like Facebook and Twitter and Apple and Google. They just have so much monopolistic power. Don't forget what happened to AT&T back in the day, and they broke that up into a bazillion different companies, right? So what he concludes that either of these factors could lead to stocks going down, perhaps by a lot, but failing because fundamentals change isn't the same as failing because a bubble burst, which typically leads prices to plummet further and faster. And again, his headline compares the current situation to a bubble. So be careful out there. We're being careful and very, very deliberate in portfolio management. But for those of you watching that have investments outside of the Camarda dome of protection, I'll call it, be cautious. And I guess that's more than enough. I've blathered on far, far too long this Thursday evening. I'm going to try to spend a little bit of time with the kids before I go to class at 8 o'clock. I still got to read one more case, Mayo Foundation versus the United States, tax case, Supreme Court case, and watch some TV with the kids, and on to law school from 8 to 10. Thanks so much for watching. Until next week, this is Dr. Jeff Camarda signing off for This Week in Well. Bye-bye.